Today, we are going to study about Accounting Standard 5, net profit or loss for the period, prior period items and changes in accounting policies. See, as the name suggests, Accounting Standard 5 consists of three main portions in its whole syllabus. The first one is net profit or loss for the period. The first one is net profit or loss for the period. The second one is prior period item, and the third one is changes in accounting policies. See, changes in accounting policies you must have studied in Accounting Standard 1, even though we are going to put forward more light on changes in accounting policies. But before that, let us study about net profit or loss for the period or prior period items. What is prior period items? What is net profit or loss for the period? And why are we studying this in Accounting Standard 5? Net profit or loss for the period, we all know what all expenses, what all incomes will come in the profit and loss statement. There needs no clarification about that. But net profit or loss for the period, what does it say? See, Accounting Standard 5, basically, why is it made? Accounting Standard 5 is basically a disclosure standard. It's a disclosure standard which is required to disclose certain items of which are extraordinary nature, or certain prior period items, or there are certain disclosure of certain items within the ordinary activities, profit or loss from the ordinary activities. What are ordinary activities? What are extraordinary items? We'll study further about that in the later part of the chapter. But it also specifies what AS5 does is it specifies basically a disclosure standard. It gives you certain insight over various terminologies, and it also specifies what are disclosures, what is the treatment needed for changes in accounting policies or changes in accounting estimates and other such cases. So, disclosure AS5 requires the classification and disclosure of extraordinary and prior period items, and the disclosure of certain items within prior profit or loss from ordinary activities. It also specifies the accounting treatment for changes in accounting estimates and the disclosures to be made in financial statements regarding changes in accounting policies. We know what changes in accounting policies are. We'll study much further about changes in accounting estimates. And let us start with the net profit or loss for the period. Net profit or loss for the period. What is net profit or loss for the period? We know what would be the expense or income which will form part of your net profit. But basically, what this standard does is it divides the net profit. It divides the net profit or loss, that is the profit or loss, into two different activities, coming out from two different activities, which is profit or loss from ordinary activities and profit or loss from extraordinary activities. Profit or loss from ordinary activities and profit or loss from extraordinary activities. So basically these two are components of the net profit or loss, but they have just divided into two activities, which is from ordinary activities, what is from extraordinary activities. Now, starting with the profit or loss from ordinary activities. Now, as the name suggests, profit or loss from ordinary activities basically it's just it is just the profit or loss which arises from ordinary activities of the enterprise, which is a part of the business. It is a part of the business, is undertaken by the business as a daily activity, and which is related to the enterprise, which is related to the business in which the enterprise is engaged. Or it might be incidental or arising from these activities, but the basic point over here is that these profit or loss come from ordinary activities, that is from the regular day-to-day activities which the enterprise conducts, for which the enterprise has been made for. So this is profit or loss from ordinary activities. See, any activities which are undertaken by the enterprise as part of its business, and such related activities in which the enterprise engages in furtherance of, incidental to, or arising from these activities. For example, profit on sale of merchandise or loss on sale of unsold inventory at the end of the season. See, at the end of the season, all these are ordinary activities. That is what the enterprise does day to day. Like it makes certain expenditures relating to its office and administration. Office and administrative activities are ordinary activities. It manufactures that manufacturing activity is an ordinary activity. It sells, it markets, these marketing and selling activities are its ordinary activities. So every single ordinary activity which is for which the business has been made of, and for which is incidental to the main business, that is ancillary to the main business, all activities are relating to the ordinary activities, and any profit or loss arising from these ordinary activities are known as profit or loss from ordinary activities. We'll further study about extraordinary items. Ordinary activities was simple. That is day to day, every day we know what the business conducts, what all expenditures, what all incomes comes for the business. That is a routine thing. It does not have anything in specific. But what is extraordinary item? Extraordinary item, now again, as the name suggests, it is over and above the ordinary items, which is extra above the ordinary item. That is, they are those activities which are clearly distinct from the ordinary activities. Clearly distinct from the ordinary activities. So if they are clearly distinct from the ordinary activities, they might not be done frequently or not be done frequently or regularly. So these are extraordinary items that means they happen once in a while, probably even once in many years, but they are of such nature which are clearly distinct from ordinary activities that means none of the enterprise would have thought that this would be an ordinary item for me, or none of the enterprise would have planned for such an extraordinary item. So extraordinary items, why is it needed? When such extraordinary items happen separately, what AS5 says, that you need to separately disclose such profit or loss from extraordinary item. So in that period, if there is any extraordinary item that has occurred, you need to separately disclose the profit or loss from that extraordinary item. Not in the notes to accounts, in the face of the P&L only. So in the face of the P&L, you need to separately disclose if there is any profit or loss from extraordinary item. So automatically, what happens is profit or loss from ordinary activities will get bifurcated. So that is extraordinary item. We'll take some examples, but first of all, let us understand why extraordinary item can be different from other one or another enterprises. See, the nature and amount of each extraordinary item, the nature of every extraordinary item must be different for one enterprise, must be different from other enterprise. Let's take an example. Let's say, for example, loss due to earthquake. Loss due to earthquake is an extraordinary activity. It's an extraordinary thing for every other enterprise. But for an insurance company, loss from an earthquake arising, all that insurance claim arising due to loss from an earthquake, that's an ordinary activity. That's what insurance companies are meant for. So it's an ordinary activity for in an insurance company to receive claim for a loss from earthquake. But a loss from earthquake actually is not an ordinary item, because it's not an ordinary item for ordinary activity for an enterprise other than the insurance company. So basically what happens, it depends on enterprise to enterprise whether an event is clearly distinct from an what we have to do is, the first rule is that extraordinary item should be clearly distinct from that ordinary activities. So whether that event is clearly distinct from ordinary activities is determined by the nature of the activity and the nature of the business also. In relation to the business, nature of the activity in relation to the business. So basically it depends on enterprise to enterprise what all extraordinary items can be happen. But the first thing should be clearly distinct from ordinary activities. There should be no relation to ordinary activities. Let's say, for example, a loss from earthquake. No, it's not an ordinary activity. No enterprise would have thought about getting a loss from earthquake and would have been ready for that. See, earthquake is a natural calamity, and no enterprise would be ready for a loss from an earthquake. So basically, it's not a part of your ordinary activities. It is clearly distinct from extraordinary items. Now again, let us not get confused over here about whether profit or loss from sale of fixed asset or profit or loss from investments or such items which are not frequently or regularly occurring are a part of extraordinary item. See, the rule does not say that every item which is not frequently occurring or not recurrent does not mean that it is an extraordinary item. Even if it is infrequent, it can be an ordinary activity. We'll further study about how do we classify profit or loss from sale of fixed asset or such types of infrequent in nature activities. So basically, these are not extraordinary items because they are not clearly distinct from ordinary activities. That is, they are not clearly distinct from the activities of the enterprise. Profit or loss from sale of fixed asset, it is not an extraordinary item. Why is it not an extraordinary item? See, understand, an enterprise has assets, enterprise has liabilities. Over a period of time, an enterprise, because it has purchased an asset, over a period of time, once its useful life is over, an enterprise will definitely sell the asset. So it's not something that the enterprise might not have thought about it, that oh no, okay, I'll have to sell this asset. That is not something I've thought about it. If you have purchased an asset, you definitely will have to sell it. So basically this is not an extraordinary item, it is a part and parcel of the business. No matter that it might occur infrequently, but it is a part and parcel of the business, because the business has assets. Over a period of time, they might have to sell the asset, and their profit or loss might incur from that. So basically, extraordinary items should be such items which are clearly distinct from ordinary activities. That is, the enterprise might not have thought about such loss, profit or loss from extraordinary items. So these are extraordinary items. We look at the screen. The nature and amount of each extraordinary item should be separately disclosed in the statement of profit and loss in a manner that its impact on current profit or loss can be perceived. So we discussed about that for extraordinary items, the nature and amount should be separately disclosed on the face of the P&L, on the statement disclosed in here it's written disclosed in the statement of profit and loss in a manner that its impacts on current profit can be perceived. Whether an event or transaction is clearly distinct from ordinary activities or enterprise is determined by the nature of the event or transaction in relation to business ordinarily carried on by the enterprise, rather than by the frequency with which such events are expected to occur. So frequency is not the point. The main thing is that that activity should be clearly distinct from the ordinary activities of the enterprise. Therefore, an event or transaction may be extraordinary for one enterprise but not so for another enterprise, because of the difference between their respective ordinary activities. For example, losses sustained as a result of an earthquake may qualify as an extraordinary item for many enterprises. However, claims from policyholders arising from earthquake do not qualify as an extraordinary item for an insurance enterprise that insures against such risk. So basically what we did was we discussed what is extraordinary item, why it should be clearly distinct from ordinary activities, and why extraordinary items can be different from enterprise to enterprise, because it basically depends on the nature of the enterprise, nature of the business carried on by the enterprise. Examples or events, let us take some examples of extraordinary items. Examples or events or transactions that generally give rise to extraordinary items for most enterprise, which are, the first one is attachment of property of the enterprise. So if a property gets attached by the government or any government authority, that's an extraordinary item that does not happen for any enterprise. It's not an ordinary activity for any enterprise. An earthquake. Now again, an earthquake is an extraordinary activity. It's not an ordinary item for any enterprise, except, let's say for example, if we are talking about claims of earthquake for insurance company, that claim portion is an extraordinary item. But if an insurance company faces loss due to an earthquake on itself, then it's an extraordinary item for an insurance company also. So basically earthquake is an insurance company. We can take another example of a refund of government grant. So if you studied in AS12, refund of government grant, now this is an extraordinary item. None of the enterprise would have thought about a refund of government grant. So all these are extraordinary items, which are clearly distinct from ordinary activities. Now let's talk about exceptional items. See, we talked about profit and loss from sale of fixed asset, and we discussed why is it not an extraordinary item. Even though it occurs infrequently, it is not an extraordinary item, it is a part of your ordinary activities only. But even though it is a part of your ordinary activity, you need to separately disclose such items. Why do you need to disclose such items separately? See, profit or loss will be divided into two parts only, from ordinary activities, from extraordinary activities. But within the ordinary activities, there are some activities. Within the ordinary activities, I'm again repeating, there is a major confusion over here. This is not a third type of activity. We're talking about exceptional items. Now see, exceptional items are not a third type of activity. They are a part of your ordinary activity only. They are a part of the business's ordinary activities. However, the separate disclosure is necessary. Why? Because even though they being a part of your ordinary activity, they are of such size, nature or incidence, they are of such size or nature of incidence that the disclosure is definitely necessary. If let's say for example, profit or loss on sale of fixed asset, there is a huge profit due to sale of fixed asset, or there is a huge loss due to sale of fixed asset, it is a part of your ordinary activities. But if you show it separately, then what happens is the shareholders will be able to judge, the shareholders will be able to perceive what the enterprise actually, what profit did the enterprise actually incur, because this is a profit or loss from sale of fixed asset. There might be a loss this year, but that won't be the case every year. So this will help in the decision making of the shareholders. So basically, what are exceptional items? They are a part of ordinary activities, but their size, nature, or incidence of such activities are so different. The size, nature, or incidence are so different that the disclosure is necessary. The disclosure is necessary for the enterprise, for the enterprise to show the real performance of the enterprise during that period of time. So we discussed why if there is a loss on sale of fixed asset, why is it shown separately, so that the shareholders can perceive that yes, there is a loss on sale of fixed asset, but it is in this year, it might not be in the next year, so the profit will increase in the next year. So that is exceptional items. What are the different kinds of exceptional items? We'll study more about exceptional items. See, circumstances which might lead for a separate disclosure of items of income or expenditure from ordinary activities are, let's take an example of litigation settlement. So legal cases, whether legal cases are exceptional items, whether legal cases are exceptional items, whether they are from ordinary activities, whether they are extraordinary items. So the question is whether it is an extraordinary item or not. So the answer is, see, any company, it's a separate legal entity which has the power to be sued or sue in its own name. So basically, it's a general feature of it's a basic feature of a company. So what happens is, if there is a legal entity, legal case on the company, and if there is any litigation settlement to be made, no matter the amount of the litigation settlement, because the company is a separate legal entity, it is a part and parcel of your ordinary activities only, that because you are a legal entity, this is bound to happen, that there might be a court case, there might be a case, and the company might have to make a litigation settlement, make a litigation settlement. So it's not an exceptional item. It's not an exceptional item. Let's, for example, if we take an example of an insurance company, there are so many cases pending against an insurance company. So basically, it's not that they are extraordinary items, that is, they are clearly distinct from ordinary activities. If you are conducting ordinary activities, in between those ordinary activities, if there is a glitch or there is some problem, there might rise a litigation settlement. And this is a part and parcel of your ordinary activities. But due to litigation settlement, because you're charging it to the profit and loss account, due to litigation settlement, your profit for the current period might come down drastically. So basically, it's not like the company did not perform well. The company might have performed well, but due to this exceptional item, the profit for the current year has reduced drastically. So what happens is, due to the size, nature, or incidence of such activities which are a part of your ordinary activities, but their size or their nature is such that the enterprise needs to disclose it separately, so that the shareholders can perceive the actual performance of the enterprise. So basically, what are the different examples of such exceptional items? See, the different examples are: the first one, the write down of inventories to net realizable value, as well as the reversal of such write downs. So in AS2 we studied about cost or NRV, whichever is lower. If you are writing down your inventories to net realizable value, that is even below cost, then it is an exceptional item for the enterprise, because it's of a different nature. Not necessary that the size should be different, but it should be of different nature also. B, a restructuring of the activities of an enterprise and reversal of any provisions for the cost of restructuring. So restructuring, if there is a major restructuring of the activities of the enterprise, it does not mean it's an extraordinary activity. It is an ordinary activity, because you are just restructuring the ordinary activities of the enterprise. So if you are making any provision for that, if you are reversing any provision for that, these are all exceptional items. See, disposal of items of fixed asset, disposal of long-term investment. So all fixed asset, long-term investment, all these disposals are exceptional items. They might result into profit or loss, but they are of exceptional items because they do not occur frequently and not a part of the day-to-day business activities. Legislative changes having retrospective application. Let's take an example of revision in pay. If there is a revision in pay, see, if there is a revision in pay, what happens is a company might have to make a provision, or company might have to provide for a huge sum of money because of revision of pay retrospectively. So is payment of wages an extraordinary item? No, right? So that does not mean, that makes it that revision in pay retrospectively, it is not an extraordinary item, it is an ordinary activity. But because there is a revision in pay and because the size is huge, it's an exceptional item. Because not frequently, this revision in wages does not occur very frequently, and whenever it occurs, it's of such size or nature that the separate disclosure is required for the shareholders to understand that why the company is performing well, or why the company is not performing well in the current year. So legislative changes having retrospective application, litigation settlement, which we discussed right now, other reversals of provisions, all these are exceptional items which might need separate disclosure, but that does not mean that they are extraordinary item, profit or loss from extraordinary activities. So that is exceptional items. See, many people confuse that exceptional items is a third part of activities. But let us clear it once again that there are just two types of profit or loss are just from two types. One is from ordinary activities, one is from extraordinary activities. Exceptional items are a part of your ordinary activities only. But a separate disclosure is required because of the size, nature, or incidence of such activities. So that is exceptional items. Let us now move forward to prior period items. Here we have completed net profit or loss for the period. From in the starting of the chapter, I said that this chapter is divided into three parts: net profit or loss for the period, prior period items, and changes in accounting policies. So we are completed with the net profit or loss for the period, where we studied that net profit or loss for the period can be divided into two parts: from ordinary activities, from extraordinary activities. Ordinary activities are from the general routine nature of the business, activities of routine nature. Extraordinary items are activities which are clearly distinct from ordinary activities, and this might change from enterprise to enterprise. And then we studied about exceptional items, that because of size, nature, or incidence of some activities, they might be different. They might be different from ordinary activities. So, but they are a part of ordinary activities, but separate disclosure is required for such exceptional items. Let us move forward to prior period items. Net profit or loss for the period is complete. Prior period items. Now, what is prior period items? This is a very important point. What is prior period items? See, prior period items are incomes or expenses. See, the definition is very important, so we need to read the definition correctly. Prior period items are incomes or expenses which arise in the current period, as a result of error or omission, in the preparation of financial statements of one or more prior period. Again, slowly going. Prior period items are incomes or expenses. So basically they are incomes or expenses. So it will only form part of your statement of profit and loss. They are items of incomes or expenses which arise in the current year, period, but as a result of error or omission. It has to be as a result of error or omission. This is a very important point. It has to be as a result of error or omission in the preparation of financial statements of one or more prior period. Now see, remembering what prior period items is very necessary. Let's take a real life example. Let's say prior period items like karma. So what is karma says that because of your previous deeds, that because of the errors or omissions that you have made in your previous deeds, because of that, if there is any gain or loss that is occurring in the current year, that is known as karma. So basically through karma, what happens is, through karma, we can remember what prior period item is. What is prior period items? Accounting says prior period items is just like karma. that because of those income or expenditures, that is gain or loss, which are occurring in the current financial year, which are occurring right now, which are occurring in the current financial year, current period, as a result of errors or omissions, that is the bad deeds or the good deeds that you have done in the past as a result of errors or omissions in the preparation of financial statements of one or more prior period. So through this way you can remember what is prior period items. Again, let us again revise what is prior period items. Income or expenditures which arise in the current period. Income or expenditures which arise in the current period as a result of errors or omissions, as a result of errors or omissions in the preparation, of financial statements of one or more prior periods. So it is arising in the current year, but as a result of errors or omissions in the prior period. So that is known as prior period items. So prior period items, what is prior period items? Why are we discussing about it? See, if there is any prior period items, again AS5 says that it needs to be separately disclosed in the financial statements. So there might be errors in the preparation of financial statements of one or more prior periods, but due to that, if there is any income or expenditure which is arising in the current period, you need to record that, in this the current period. So basically, if you are recording something which belongs to the prior period, but you are recording it right now, you need to separately disclose it, so that the shareholders know that yes, this particular error or omission, due to particular error or omission in the prior period, this particular income or expenditure is being shown here in the current period. So errors may occur, errors or omissions. What does error or omission means? Error may occur such as mathematical mistakes or misinterpretation of fact, or if there is an increase in amount or decrease in amount, if you have shown less expenditure rather than what actually happened, or if you have shown less income rather than what actually you have earned. So basically all these are errors which are made, or omissions which you are making, in the preparation of financial statements of the prior period. Let's take an example. Let's say there's an outstanding liability which the company has not recorded. So there's an outstanding liability. When it's time to pay the liability, the company realized that it did not record the liability in the previous year. So it has made an error or omission. Which has arisen in the current year. For income or expense has arisen in the current year, and which is known as a prior period item. So this is a prior period item. Which needs to be separately disclosed in the financial statements. It might be due to various kinds of errors or omissions, or any kind of error or omission. The next one, the nature and amount of prior period items should be separately disclosed in the statement of profit and loss in a manner in that their impact on the current profit or loss can be perceived. See, basically prior period items do not belong to the current year, but they are still recorded in the current year in the statement of profit or loss for the current year. So because of that, the actual profit figure of the current year, may vary. So that the shareholders know that what is the actual profit figure of the current year, that because this related to the prior period. So the shareholders would not know what would be the current year's profit. So they should be separately disclosed, so that their impact on the current year's profit would be known to the shareholders, and they can now decide what is the current year's actual position of the company. Let's now start with changes in accounting estimate. So what is changes in accounting estimate? Change in an accounting estimate is basically a revision of an estimate which you have made in the past. So what is the revision of estimate? Let's say, for example, you take useful life of an asset to be let's say 7 years. But actually over a period of time, let's say after 2 years, you say that no, the useful life won't be 7 years, it is a maximum of 5 years, so it will go on for a further period of 3 years. This is the change in accounting estimate. Because you estimated the useful life to be 7 years, now you are changing it to 5 years. This is the change in accounting estimate, and what treatment would be needed to for a change in accounting estimate we'll learn over here. An estimate may be revised why is an estimate revised? An estimate may be revised due to various factors. Let's say, for example, technological changes. Let's say, for example, you brought a machine expecting a useful life to be 10 years. It has a useful life of 10 years, no problem about that. The machine will work on for 10 years. But after 3 years or 4 years, there is a major technological development and there is a new machine available. There is a new machine available in the market with higher productivity and better quality products. Now what happens for the enterprise to keep an edge in the market? The enterprise will have to change the machinery. So it expects the useful life. What it does, that is, it changes the estimate. It used the estimate of 10 years. Now it is estimating the useful life to be a maximum of 6 years or 7 years, because due to rapid change in technology, after say 3 or 4 years, they'll have to take a new machinery. So what happens is, this is a change in accounting estimate. It is due to, let's say for example, it's due to technological development. It is due to new information available to the enterprise. Let's say for example, the enterprise has wrongly been using the machine, and due to that, now the enterprise realizes that though it has expected a useful life to be 10 years, now the useful life would be only 5 years. So this is a change in accounting estimate due to new information available to enterprise, or due to technological developments or any other subsequent development due to which there might be any changes in accounting estimate. So accounting estimates, there are many examples of accounting estimate. One is a useful life, one is the scrap value of the fixed asset, and there are many other accounting estimates which can be changed. See, what are accounting estimates? That you're estimating a certain amount to be charged due to some certain factors which are associated with the asset. So what happens is, an estimate may have to be revised if the changes occur in the circumstances based on which the estimate was made, or as a result of new information, more experience, or subsequent development. The revision of the estimate by its nature does not bring the adjustment within the definition of an extraordinary item or a prior period item. So what is AS5 says, that we all know what change in accounting estimate is. What is an accounting estimate? We know what is an accounting estimate. We know that changes in accounting estimate occur due to certain factors. But how do we classify as change in accounting estimate? Whether it is an extraordinary item or whether it is a prior period item. It definitely is not an extraordinary item. It's just a change in accounting estimate. It's a routine activity. But whether it is a prior period item, no. See, there is a difference between change in accounting estimate and a prior period item. Prior period items, basically income or expenditures due to error or omission arising in the current year due to error or omission in the prior years. This is not an error or omission. You are, at that point of time, you were right that expecting that useful life to be 10 years. So at that point of time, you did not make any error or omission. The asset had a useful life of 10 years. You are taking the useful life to be 10 years. But after 3 or 4 years, due to subsequent developments, what happened? The useful life reduces to 7 years. So naturally you might have provided less depreciation, and now you will have to provide more depreciation. But that does not mean this is a prior period item. This is not a prior period item. It was not due to error or omission. It was just due to revision. Say, let's say for example, if everything went on as expected, there wouldn't be any change in the useful life, and then there won't be any problem only. So what happens is that because of the change in subsequent developments or change in your useful life, so there is any technological development or any other changes due to which revision is needed, that revision accounts to change in accounting estimate, and that does not mean that it is a prior period item. See, accounting estimates by their nature are approximations that may need revision as additional information becomes known. So they need revision as additional information becomes known. We'll have a look at the example. For example, Sachin purchased a new machine costing rupees 10 lakhs. Useful life was taken to be 10 years. Therefore, depreciation was charged at 10% on original cost each year. So they are following this straight line method. So 10% original cost every year they are providing 1 lakh rupees as depreciation, because the useful life was taken to be 10 years. Now here the accounting estimate made was that useful life would be 10 years. However, after 5 years, when carrying amount was rupees 5 lakhs for the machine. How is it rupees 5 lakhs? After 5 years, for 5 years depreciation, total 5 lakhs depreciation was provided on 10 lakhs. So 10 lakhs minus 5 lakhs, the carrying amount is 5 lakhs for the machine. Management realizes that the machine can work for another 2 years only. So basically you had an original estimation of 10 years, original estimation of useful life of 10 years, but after 5 years, what happens is you estimated again that the machine will work only for the next 2 years. So that makes it a total of 7 years. So your accounting estimate changes from 10 years to 7 years. So what it has to do, because the carrying amount is 5 lakhs and the further useful life is just 2 years, it has to divide the whole amount in those 2 years. So that is why 5 lakhs divided by 2, that is 2.5 lakhs depreciation you have to provide in each year for the upcoming 2 years. You were providing 1 lakh depreciation, now you are providing 2.5 lakhs for the upcoming 2 years. For the upcoming 2 years, basically, is that a prior period item? No, that is not a prior period item. It is not an error or omission which you made. Basically, at that point of time when you purchased the machinery, the useful life was expected to be 10 years. But due to some changes, due to some revision, there was a change in the accounting estimate and the useful life reduced to 7 years. That is why the incidence of depreciation in the last years, that is in the 6th and 7th year, is much more than the incidence of depreciation in the first 5 years. So there is a change in accounting estimate. What is the prior period item? We will take another example. Prior period items, this is not a, let's look at the example again. This is not an example of prior period item but change in accounting estimate. In the same example, management by mistake, calculate by mistake, yes again, read again, by mistake, though that is an error or omission, calculates depreciation in the 5th year as 10% of 6 lakhs. So basically in the 5th year, that is at the end of the 4th year, the carrying amount is 6 lakhs. So on 6 lakhs it provides depreciation at 10%. Now the company was following the straight line method. Company was following the straight line method. It had to provide a depreciation of 1 lakh. Instead, it provided a depreciation of 60,000 only. So, and in the next year, what it does is that because it has provided 40,000 less depreciation in the previous year, it decides to write off 1,40,000. That is 1 lakh for that current year and 40,000, which it 1 lakh for the current year and 40,000, which it had not written off in the previous year. So basically, this is an prior period item. Why? Because you have made an error or omission. You had to provide 1 lakh, you provided only 60,000. This is an omission of 40,000 rupees. So 40,000 you have made an error or omission in the previous year, which has arisen in the current year, because you have to provide depreciation, you have to bring down the carrying amount. So which is arising in the current year. So what you have to do is that 40,000 rupees should be shown as a prior period item. 1 lakh is a normal depreciation which needs to be provided, but the 40,000 should be shown as a prior period item. So in such a case, rupees 1 lakh's current year depreciation and rupees 40,000 will be considered as prior period item. So that is known. So through this example, we learned what is change in accounting estimate and how do we ascertain that something is a change in accounting estimate or is it a prior period item. So basically, change in accounting estimate does not need any separate disclosure, but prior period item does need a separate disclosure. The effect of a change in accounting estimate should be included in the determination of net profit or loss in the period of the change if the change affects the period only, or the period of the change and future periods if the change affects both. See, basically changes in accounting estimate, we'll learn about the disclosure portion later on, but here let's see what are the effects of changes in accounting estimate. See, in changes of accounting estimate, the effect might be only in the current year, or it might be in the current year and the future periods also. So basically, it ascertain whether that change in accounting estimate has the effect only in the current year or in the current year and the future years as well. So for example, a change in estimate of the amount of bad debt is recognized immediately. So if you have recognized any bad debt amount and the bad debt actually comes to be higher than the estimated amount, you increase it, and this is known as a change in estimate. Let's say for example, you estimated a bad debt to be 1 lakh rupees. You made a provision for 1 lakh, but the bad debt came out to be 1,50,000. Now you are changing the estimate from 1 lakh to 1,50,000. So this is affecting only the current period. It is affecting only the current period. From 1 lakh to it increases to 1,50,000. But as we took the example of depreciation about Sachin, what happens is the change in accounting estimate results to change in depreciation provided for current year also. That is 2.5 lakhs in the 6th year, and for future years also, that is 2.5 lakhs in the 7th year also. So this is a change in accounting estimate. The effect is on current period also, and it is on the future period also for the remaining useful life of the asset. So let's take an example of that. However, a change in estimated useful life of a depreciable asset affects the depreciation in the current year and each period during the remaining useful life of the asset. So the remaining useful life was 2 years. So in this period plus another year in this, that is the next year, there is a change in the effect of changes in accounting estimate can be seen. The nature and amount of a change in accounting estimate which has a material effect. Let's discuss about disclosure portion. The nature and amount of a change in accounting estimate which has a material effect in the current period or which is expected to have a material effect in the subsequent period should be disclosed. If it is impracticable to quantify the amount, the fact should be disclosed. So what happens is, basically, if there is a material effect due to change in accounting estimate, immaterial, are not talking about immaterial effect. If there is an material effect, the same should be disclosed. So basically, you just need a disclosure that what effect did the change in accounting estimate have on current year and on future years. So this is change in accounting estimate. Change in accounting estimate, the disclosure is required only if the change is material in nature, you need to disclose what effect did it have in the current year and in the future years to come. So this is about change in accounting estimate. Let us now move forward to change in accounting policies. That is the third part of the accounting standard. We discussed earlier that accounting standard, we completed net profit or loss for the period, prior period items, and now we are going to start accounting policies. So what is accounting policies? Accounting policies are specific accounting principles and methods of applying those principles adopted by the enterprise in the preparation and presentation of financial statements. So basically, accounting policies you might have studied it in accounting standard 1. So basically, what are those? They are specific accounting principles, and even the methods of applying those principles adopted by the enterprise. That means that accounting policy, if accounting standards specifies any policy which needs to be followed, the enterprise will have to follow that policy. So there are specific accounting principles, and the accounting standard even specifies the method in which they have to follow the accounting policy. That is also for that accounting principle, that also forms part of the accounting policy. Now we know that accounting policy can be changed only in 3 circumstances: when the adoption of different accounting policies required by the statute, that is by law. By law, the law says that you have to take another accounting policy to prepare your financial statements. So by law. The next one is for compliance with accounting standard, that is by accounting standard. And the third one is when it is considered that the change would result in more appropriate presentation of the financial statement of enterprise. That is better presentation of financial statement if there is a change in accounting policies, so that it reflects the true and fair view of the financial statements. If there is any change in accounting policy, only in these 3 circumstances can we change the accounting policies. The following are not changes in accounting policies. We will have a look at the list of what are not change in accounting policies. Basically, accounting policies, I hope you understand, they are just specific principles and the method of applying those principles. So what are not accounting policies? The adoption of an accounting policy for event or transactions that differ in substance from previously occurring events or transactions. Example, introduction of a formal retirement gratuity scheme by an employer in place of an ad hoc ex gratia payment to employees on retirement. So basically, see here in this question, what happens is the adoption of accounting policy for events or transactions that differ in substance from previously occurring events or transaction. So from previously occurring events or transaction, if there is a change in accounting policy, if you have adopted any other accounting policy, due to change in events or transactions, if you have taken another accounting policy, that is not known as change in accounting policy. For the same event or transaction, if you are changing the method of calculating that event or transaction or method of accounting for that event or transaction, that might be known as an change in accounting policies. But if you have adopted an accounting policy for an event or transaction that differ in substance, basically that event or transaction is different from the event or transaction that have already occurred in the previous year. So if there is a change in different event, that accounting policy won't be applied for. It's not necessary that you apply the same accounting policy for what you have applied in previous past. So because there is a significant change in the events and transactions, nature of events and transactions, what happens is this cannot be termed as a change in accounting policy. You're just adopting a different accounting policy than what you have adopted in the past. The next one, the adoption of a new accounting policy for events and transactions which did not occur previously or that were immaterial. So if there is any small change, small event or transaction that did not occur previously, it's a fresh transaction or event. So basically, obviously, you will that won't be change in accounting policy. You will follow a new accounting policy. Or if they are immaterial if they are immaterial, if there is any change in accounting policy which is immaterial, you do not have to disclose all that. So that is change in accounting policy. See, any change in accounting policy which has a material effect should be disclosed, which we discussed earlier, that if it has a material effect, we should disclose it. If it is not, that's okay to ignore it. The impact and the adjustment resulting from such change, if material, should be shown in the financial statements of the period in which such change is made to reflect the effect of such change. Where the effect of such change is not ascertainable wholly on part, the fact should be disclosed. So what changes, what impact did the change in accounting policy have on the current period, and what impact will it have in the future period? Everything needs to be disclosed if there is a change in accounting policy. If you cannot quantify the effect that due to a change in accounting policy, the company has an increased profit of this and this amount, or a decreased profit of this and this amount, or a loss of this much amount. So basically, if you cannot quantify all of these, that fact should be disclosed, that the enterprise is unable to quantify the impact of the change in accounting policy. So you have to disclose the impact of the change in accounting policy if it is material. So here we completed the conceptual portion of Accounting Standard 5, which is net profit or loss for the period, prior period items, and changes in accounting policies. For net profit or loss for the period, we saw that profit or loss for the period can be divided into two parts, or from ordinary activities or from extraordinary activities. Ordinary activities is day-to-day routine of the business, that is for the purpose for which the business was established, and all other areas incidental to the business of the enterprise. For extraordinary activities are those activities which are clearly distinct from ordinary activities. We took some examples of extraordinary items. Let's say earthquake, a refund of government grant, or attachment of a property. Then we studied about exceptional items, which are a part of our ordinary activities, but their size, nature, or incidence is so different that a separate disclosure is required. So we have to disclose the profit or loss for the period as basically three parts: the ordinary activities, exceptional items, and extraordinary activities. So that is how. Then we studied about prior period items. Prior period items, incomes or expenses arising in the current year as a result of errors or omissions in the preparation or presentation of one or more prior periods. So that is the prior period items. So, and then we studied about changes in accounting estimate, how it is different from prior period item, and how do we disclose changes in accounting estimate. Then we studied about change in accounting policies, the conditions, the situations in which change in accounting policy is required, and what all disclosures are needed. The change in accounting policy can impact the current year as well as the future years also. So what disclosures are necessary, we studied about that. Let us now have a look at the illustrations so that we have better understanding about the questions that might be asked in the examinations. So let us have a look at the illustrations. Illustration number one, which says that fuel surcharge is billed by the State Electricity Board at provisional rates. Final bill for fuel surcharge of rupees 5.3 lakhs for the period October 2008 to September 2015 has been received and paid in February 2016. However, the same was accounted in the year 2016-17. Comment on the accounting treatment done in the same case. Now see, if you do not read the question again, you might not be able to ascertain the problem over here. The problem is not that the fuel surcharge of 5.3 lakhs for the period October 2008 to September 2015 has been received. But the thing over here is that it has been received and paid in February 2016. It has been received and paid in February 2016. However, the accounting was done in 2016-17, that is the next year. So basically, you had to do your accounting, that is for 5.3 lakhs. 5.3 lakhs needs to be shown in the accounting period of 2015-16. That is when it is received. That is in February 2016. So it needs to be done in February 2015-16. However, the accounting was done in 2016-17. That means in 2015-16, you made an omission of not recording 5.3 lakhs, which you have rectified. That means which had an impact in the current year, that is 2016-17. So what does it conclude to? Yes, that is a prior period items. Why prior period items? They are income or expenditures arising in the current year due to error or omission in the preparation or presentation of one or more prior period. So because there was an omission in 2015-16 for which the recording was done in 2016-17, this 5.3 lakhs should be shown as a prior period item and should be disclosed separately. Now see, many of you might be confused, sir, whether final bill for fuel surcharge, whether final bill for fuel surcharge of 5.3 lakhs from the period October 2008 to September 2015, is it shouldn't it be prior periods from October 2008? No, that is not a prior period. Basically, the expenditure, there was no error or omission for that. Expenditure was the billing was done on provisional rate. The expenditure was booked on provisional rate. Because of the final bill from October 2008 to September 2015, the final bill 5.3 lakhs, this was a supplementary invoice, so a final bill was raised for 5.3 lakhs. So 5.3 lakhs is not due to error or omission. It was actually been incurred in 2015-16 only. So this is not prior period items. The prior period items, the main point is that it is a prior period items because it was recorded in 2016-17. Had it been recorded in 2015-16, it would not have been a prior period item. Then what should it be? How do we classify this 5.3 lakh, the expenditure of 5.3 lakh? Whether it would come in the profit or loss from ordinary activities, whether it would be an extraordinary activity, or whether it should be an exceptional item. What do you think about that? See, basically fuel surcharge, because it was by the State Electricity Board, because it was given on a provisional basis, the company knew that it will have to, again, if there was any revision or if there was any retrospective amendment, if it will have to pay a fuel surcharge. So what happens is, and basically fuel, all these are due to ordinary activities only. These are part and parcel of the day-to-day business of the activities, day-to-day activities of the business. So what happens is that it's not an extraordinary item that has been ruled out, but the thing is whether it is an exceptional item or not. Yes, it is an exceptional item because of the size, nature, or the incidence. The incidence is happening in February 2016 for an expenditure which ranges from October 2008 to to September 2015. So basically that is 5.3 lakhs is basically an exceptional item. So let us now have a look at the solution. We'll discuss more about it. The solution says that the final bill having been paid in February 2016, should have been accounted for in the annual accounts of the company for the year ended 31st March 2016. However, it seems that as a result of error or omission in the preparation of financial statements of the prior period, that is, for the year ended 31st March 2016, this material charge has arisen in the current period, that is, year ended 31st March 2017. Therefore, it should be treated as a prior period item as per AS 5. So that's what we discussed. It should be treated as a prior period item because it was not accounted in the year in which it was billed and paid. As per AS5, prior period items are normally included in the determination of net profit or loss for the current period. An alternative approach is to show such items in the statement of profit and loss after determination of current net profit or loss. In case the objective is to indicate the effect of such items on the current profit or loss. So basically, it should be included in the determination of net profit or loss for the current period, but you have to show it separately so that the shareholders can come to know of the impact that the prior period item had on the current year's profit or loss. It may be mentioned that it is an expense arising from the ordinary course of business. Yes, that's what he discussed. It is an expense arising from the ordinary course of business. However, although abnormal in amount or infrequent in occurrence, such an expense does not qualify as extraordinary item as per AS 5. For better understanding, the fact that the power bill is accounted for at provisional rates billed by the State Electricity Board and final adjustment thereof is made as and when the final bill is received may be mentioned as an accounting policy. So basically what happens is, this is an exceptional item. So it's an exceptional item. You can, because of the amount, because of the nature of expense, though it is an ordinary activity, it can be shown separately, and there can be a separate disclosure made that in the previous years, the accounting policies or what the accounting policy should be followed, that as and when the expense would be accounted at the provisional rate only, and the final bill, the final adjustment thereof is made as and when the final bill is received. So final bill is received in the year February 2016, and that is the year in which that accounting should be done, and that can be termed as an accounting policy. The accounting policy, what does it say? That the billing would be done in the previous years on a provisional rate basis, but when the final rate comes, that will be done in the year when the final bill was received by the enterprise. So that is a question, illustration number 1. Let's now move towards illustration number 2. Now this is divided into 2 questions. There are 2 separate questions. Let us have a look at the first question. The first question says that during the year 2016-17, a medium-sized manufacturing company wrote down its inventory to its net realizable value by rupees 5 lakhs. Is there separate disclosure required? Is a separate disclosure necessary? So the first question is medium size. Let us discuss the answer about it. We'll look at the answer later on, but let us discuss the answer about this. During the year 2016-17, a medium size manufacturing company, does not matter if it is a medium size or large size, it wrote down its inventory to its net realizable value by rupees 5 lakhs. So 5 lakhs has been written off from the closing stock. It has written down to a net realizable value. Is a separate disclosure required? Now we saw about the net profit or loss for the period can be divided into 2 parts, ordinary or extraordinary item. First you have to look whether this is an extraordinary item. No, it's not an extraordinary item. You are writing down the inventory of your own company. It's a part of your business only. So this is from the ordinary activities of the enterprise. But even though this is from an ordinary activities of the enterprise, the size, nature and the incidence of such an event, such an activity is so different that it needs separate disclosure. So basically this is an exceptional item. What is this? This is an exceptional item. Even if when we studied about exceptional items, you can see that when we studied about exceptional items, we talked about the in certain various incidences where it will be known as an exceptional item. In that, it was the same question, the writing down of an inventory to its net realizable value, it is an exceptional item. So this will be termed as an exceptional item, and a separate disclosure would be made of exceptional items other than the profit or loss from ordinary activities. The second question, a company signed an agreement with the employees union on 1st September 2016 for revision of wages with retrospective effect from 30th September 2015. So from 30th September 2015, there was a retrospective effect of wages. So employee union, this would cost the company an additional liability of rupees 5 lakh per annum. Is a disclosure necessary for the amount paid in 2016-17? So is the disclosure necessary? 5 lakh additional liability of 5 lakh rupees per annum. 5 lakh rupees per annum would be done. Is a disclosure necessary for the amount paid in 2016-17? See, in the question you can see that the agreement was signed on 1st September 2016 for a retrospective revision from 30th September 2015.